Hello and welcome to class number 4, I guess it would be investing, part 2 of the investment class. So we hope you enjoyed the last class session. I think that this session will be a little bit more, I think, entertaining and enjoyable. So hopefully we have a great deal of you watching this and learning from today's lesson. It's not too late to go back and watch some of the previous lessons. I've been watching kind of our viewership numbers, and they've been declining. If this were like a chart of a stock, it would not be trending in the right direction because we've been kind of going down each time. So I don't know if my material is getting less interesting, if people are getting busier now than they were, or if they're just kind of bored with this. But anyway, you can go back and still watch the previous lessons. You can do the assignments for those lessons and still get full credit. So we encourage you to do that. We've had a good class session so far, lesson 1 on kind of the basics of finance, behavioral finance, understanding kind of what goes through your mind when you're making decisions on buying things and how to budget and set goals. That led to lesson 2, where we discussed borrowing, and we talked about different loans that are available, and kind of when you should borrow, maybe when you shouldn't borrow, and just being cautious with that. Lesson 3 was our first part on investing last week, and we focused a little bit more on kind of risk return relationship and introduction to diversification and some investment do's and don'ts. Don't put all your eggs in one basket. Don't just trust other people. Some of those types of things. So today's lesson on investing will get a little more detail. We're actually going to talk about some direct investments and teach a little bit about it. So what's a stock, what's a bond, what's investing in real estate, private equity, mutual funds, some of those types of things. So our assignment last week, we invited you to look up some definitions, and I did that hoping that you would have a little bit of kind of an introduction to some of these definitions before we got into the lesson today, but we'll be going into more detail for sure. So let's get into it. So we'll start with stocks. What is a stock? Basically, when you own stock in a company, you own a small piece of that business. I like to use Disney as an example because most people like Disneyland, and so they think, oh, that's cool if you could own Disneyland. So if you buy Disney stock, you own, a small ownership of the company. All right. So as that company grows in like earnings, then it will appreciate in value. The stock price will go up. Okay. So let's kind of think about a basic business that someone could start up. A kid could start up a lemonade stand. And let's just say that on the first week of creating this lemonade stand, you sell 100 cups of lemonade, and with that 100 cups of lemonade, you sell them for $1 per cup, and it costs you 50 cents per cup to make the lemonade. So you make $50 on that first weekend. So now let's say that in 4 weeks from now, your business, you have the best lemonade in town. You put just the right amount of ice in there to keep it cold but not water it down. And the weather's getting hot, and so people just want lemonade. And now your sales go from 100, and they go all the way up to $1,000. And maybe you're able to make the lemonade a little more efficient now. You've been doing it longer, and you're buying more products. So now maybe instead of earning just 50 cents on per cup, 50% on the lemonade, you're making more. So now instead of making a profit of $500, let's say you make a profit of $700. So that business now, where you're making $700 on a weekend, is more valuable than when you're only making $50 on a weekend. If you were to go out and sell that business, the person buying it would be willing to pay you more money to earn $700 than they would to earn, say, $50. All right, so that's basically how this works. It's in a much bigger scale But as Disney and as some of these other companies grow and they earn more money, the stocks become more valuable. So if you buy a stock today for $10 a share, it costs you 10 to buy it today. In the future, if they, say they double their earnings, now the stock's worth $20. So your investment that you bought at 10, you can sell later on for $20 a share. So you made money as your money has been invested. And that's the ultimate goal in investing in stocks for the most part, is that growth. In addition to that growth, if your company is earning money and you have some extra money, you can pay what's called a dividend. So you pay a little bit of income to that investor, kind of a thank you for being an investor, and that's known as a dividend. Okay, so back to the lemonade example, if you've got extra money sitting around and you have an investor in your lemonade stand, you can pay them a portion of your $750 profit or whatever it was we said, and just give them that every time you have a lemonade stand open and you make a little bit of money, you pay them a little bit. That's a dividend. And now they continue to grow your lemonade stand. When you sell it, now their ownership, what they have invested in you, or your lemonade stand will be more valuable. Okay, so that's how dividends work. As an investor in stocks, you get voting rights, and most investors, this doesn't mean too much. If you're a really, really big investor, then you can help make decisions on the company, and you can vote who's going to be the president of the company, who's going to run it. Every investor has a voting right equal to the percentage that they own. Most investors don't own enough to really make a big difference, but you do receive voting rights when you own shares. Now, stocks go up and down. I've been kind of positive here, saying, when a company grows, the price goes up, but you also see times when companies, lose value. Let's look at the current environment where we have this coronavirus and people aren't able to go to restaurants. And so a company like Chipotle, for example, their sales have obviously taken a big, big hit. Their earnings are dropping. Okay, so if that happens, and it happens over a long period of time, then the stock can drop, and it can drop significantly. Okay, so stocks, they do have risk. They're fairly high risk and high potential return, and they can go down to zero. So your investment, you can lose. Technically, you can lose your entire investment, although that doesn't happen very often. There is no maturity, what we would call maturity, on a stock like there is in a bond. And we'll talk about bonds in a minute. So there's no maturity. You can buy it today and you can hold it one day, you can hold it, 20, 30 years, it doesn't really matter. We have some clients that have inherited money from their parents that bought stocks, 50 years ago, and they still have them today. So there's no maturity. You own it. You can keep it as long as you want. When you buy a stock, they kind of break stocks down into different areas. One is by size of the company. So there's what's called small cap stocks, are companies that are relatively smaller. A lot of these you probably haven't heard of because they're smaller companies. Then you have what's called a mid cap stock, which is kind of the next level up. And then large cap is the biggest companies out there. And those are names that you've definitely heard of. I'll go over some of those in a minute. They also talk about growth and value. I don't have that here on this slide, but growth stocks are stocks of companies that tend to be growing quickly over time. Like Amazon is an example of a growth stock where it is just coming out with new ideas and new concepts, and more people are using it. They're selling more online, and so the company's just growing a lot. That's a growth stock. They also have value stocks, and those stocks are stocks that usually are a little bit more mature. They've been around longer. They've kind of gotten to the point where they're so big now that they can't continue to grow like they used to, but they'll usually pay a good dividend. They're usually less expensive than growth stock. Those are called value stocks. So within like a stock portfolio, you can own small caps, mid caps, large caps, growth stocks, value stocks. And so a good portfolio kind of puts together a lot of those different areas. So that's kind of how stocks work. So the way that it usually will happen is a company will start as a private company. So for example, like Starbucks started in Seattle as just a standalone single store, and then they started to grow and become bigger and bigger. So the owners of these companies, the people that started, they owned the company, just like the example we gave, the lemonade stand, where the person owned the lemonade stand. The company grew and got bigger and bigger, and these people, all of a sudden, this business is worth a lot of money, but there's no real way for them to kind of cash out of that company. They're making good income because, you know, all these Starbucks stores are selling a lot, and there's extra money left over that passes to them as owners, but they can't really fully, you know, capitalize on that business. So one way to do that is by taking your company that is privately owned and now taking it and issuing stock on the public market. And so that's how these stocks get out there. Usually they're companies that are started by, you know, an individual, and then they now sell that. They create a stock, and now they sell that. And so investors will come in and they'll look at your lemonade stand, and they'll see that you're selling lemonade in, you know, 40 states, and you've got them in all of the biggest cities, and man, that's really a great business. You know, you're generating millions of dollars, you know, in earnings, and so investors will come in and they'll say that's worth, you know, whatever amount of dollars, and they put a price on it, and that is now your stock. And so now, as the starter of this lemonade stand, you've issued stock. The investors now, just the general public, can go out, they can buy your stock, and that money, when you first issue that stock, that money now comes back to you as the original owner, because you owned that entire company originally. So now you're issuing stock, and so now the general public becomes the owner of it, whether it's all of it or part of it, when it's up to the person that takes the stock public. So now that money comes to them, and now they've been able to cash in and make a bunch of money on that company. So now your lemonade stand is publicly traded, and investors can buy it and sell it at any time they want, and that price of that stock is just going to change depending on how much lemonade you keep selling, and how healthy the market is and the economy is, and things like that. But the original lemonade stand owner no longer makes money every time that stock, you know, trades. That money now is just trading from investor to investor. So it's a little bit complicated. If you want more information on kind of that process, let us know. But the main takeaway is that with stocks, you own a portion of the business. Okay, so here are some stocks. You probably heard of all these companies. We won't go through them all, but some examples. We've talked about Starbucks and Chipotle, Chevron Corporation, Home Depot, Nike, Verizon, Amazon, Walmart, Netflix. You know, there's tons and tons of companies that are out there that trade, you know, on a daily basis. So the challenge for this week, I'll give it to you now, and I'll follow up later. But I want you to pick 3 stocks that you want to follow. Okay. Now, if you go to a website like Yahoo Finance, you can search on there. You can either put in a symbol for these stocks or the stock name, and it will tell you the current price of the stock. So I want you to come up with 3 stocks. Tell me the current price of the stock, and what stock it is that you want to be following. And I want you to track that stock, you know, over the next few weeks and see how the price changes up or down. All right. So, for example, Amazon is the symbol is AMZN. So if you go to like Yahoo Finance, you type AMZN, enter, and it will tell you the current price of Amazon stock. So each stock out there has a ticker symbol, is what we call it, and that's what is used to you know, to find the stock, to track the stock price. So most of them are kind of similar to the name of the company. Like Netflix is NFLX. They're usually 1 to 4 letters. Verizon is VZ. All right, so anyway, if you don't know the symbol, which many of you won't, you can always go and just look it up. You could Google search, what is the stock symbol for Facebook, and it'll tell you. So I want you to come back. I want you to tell me. I'm gonna ask you to tell me. I have to write this down so I remember. The stock you're gonna follow. I want the current price, and I want the what's called the 52-week high and the 52-week low. Okay, so that 52-week is the previous year. So the 52-week high tells you what the highest the stock price has been over that 52 weeks. 52 weeks is the lowest it's been. Okay, so I want to know the stock. Of course, give me the symbol for that stock. Current price, 52-week high, 52-week low. And these are just a few examples. If there's a certain brand or a certain store or a company that you like and you're not sure if they're public and they have a stock, you can shoot me an email. I can help you look it up. But I want you to find 3 of them, 3 stocks, and we'll see how you guys do. See maybe whose stocks do the best. All right. So let's move on. Oh, stock and index. Stock index. So everyone here probably, or most people I'm assuming, have heard of like the Dow Jones Industrial Average or the S&P 500. And what those are what's called a stock index. So the Dow Jones Industrial Average is nothing more than 30 stocks that are in kind of a basket. And so that Dow Jones Industrial Average tracks those 30 stocks. The S&P 500 is 500 biggest stocks or biggest companies in the United States. That's what makes up the S&P 500. So when one stock gets smaller than another, it drops off and another one comes in. All right. There's an EFA index, which is like an international index that tracks international stocks. Russell 1000 is U.S. small cap stocks. And there's basically an index that tracks really any asset class out there. All right. So I actually think that Russell 1000 is a large cap. Russell 4000 I think is a small cap. But anyway, they have indexes out there that track kind of any market. But if you ever hear like on the news or on the internet, the Dow is up 300 points. That's just telling you how those 30 stocks are doing, and it's supposed to give you kind of a reflection on what the overall market is doing. So these are basically just groups of stocks that kind of give you quickly an idea of what the market's doing. But nowadays you can actually invest in these indexes, and we'll talk about that later. Bonds. What are bonds? So as opposed to a stock where you own a company, a bond is a loan. So you're a lender to this company or to a government or whatever. You're not an owner of it. These bonds, usually you can buy bonds in corporate bonds, government bonds, or municipal bonds, which are bonds issued by cities and counties to build bridges or whatever, and those are not taxed. There's no federal tax on those bonds. Okay, so they're tax advantaged. But anyway, you don't own anything here. You're just a lender. So we talked about buying, let's say, Verizon stock. You can also invest in a Verizon bond where you are lending money to Verizon, and all you're going to get from them is whatever the interest is that they've agreed to pay you, and that's it. So Verizon can do really, really well as a company. They can quadruple their earnings, and that's not going to really impact you as a bondholder. All you're going to do is get your regular fixed return and then your money back at the end. All right, so kind of drawn this up on the bottom. The P is for your principal. That's your original investment that goes into this. I have that down, meaning that money is going out. You're sending that money away to invest it. And now you have these regular scheduled interest payments that I show here as I's. So every 6 months, let's just say you receive an interest payment. And then there's a set maturity on this bond. Going into it, whether this is a 3-year bond or a 5-year bond or a 6-month or whatever. And so at that maturity, when this bond ends, you get back your final interest payment, plus you get back the principal you put in. Okay, so P goes out, I coming in, and then at the end you get principal and interest coming in on your last payment. Okay, so if you invest, properly in a bond, these companies, as long as they don't go out of business while you're in there, then you get back what you put in plus the interest. So it's a little bit simpler to understand. So in this case here that I've drawn up, you invested the P and you hold that all the way to the maturity at the end, and you get back your money at the end. You don't have to do that. You could really halfway through owning this, you could decide, I don't want to own this bond anymore, I want to sell it, and then you can just go sell it, and there's a market out there for bonds, and that bond will change in price depending on mostly interest rates, but also will change in price depending on how solid the underlying company is. So if you invest in Verizon and the company does really, really well financially, then there's less risk in being a bondholder, and so that investment will still have value when you want to sell it. If Verizon is all of a sudden really, really struggling financially and they might go out of business, then this new person that would buy this bond from you would maybe be a little bit more nervous about investing in it, and so they would want to pay a lot less money because there's more risk in it now. So you might lose money on the bond. Okay, but technically, if you own the bond to maturity, you're going to get back what you put into it plus interest payments, assuming that these companies stay in business. Now, the interest rate and price relationship is interesting in bonds. So we've talked a little bit about this just now, but it's kind of like a teeter-totter. We have interest rates on one side and bond prices on the other. A lot of times the clients all hold up a pen and say, the cap is interest rates and the tip is price. Okay, and as interest rates move higher, prices drop. As interest rates move lower, prices go up. And it's pretty easy to understand why. Let's say, for example, that there's 2 bonds out there. I own one and you own one. And these bonds mature on the exact same day. They have the same amount of risk as far as the borrower paying back. So they're, all things being equal, they're the exact same. Okay. Now, if I come out tomorrow and I raise my interest rates go higher, okay, these bonds now that you had yesterday that were, say, paying 4%, maturing in 5 years, if there's a new bond issued tomorrow that pays 5% in maturing in 4 years, all of a sudden your bond that you own at 4% isn't as valuable as a new bond at 5%, because that investor in the 5% bond is going to make 5% instead of what you're making now is 4%. Okay, so your 4% bond, because interest rates have gone up, that price has gone down because it's not going to be valued as much. So essentially what happens is the price will drop enough where the new investor that comes in will pay a new price that will get that rate up to 5% or the current market rate. All right, so again, rates were at 4, now they've gone up to 5, so your bond price drops where the person now, a new investor, pays less for it, and now the price they pay for it gets them a rate of 5% equal to the other bond that comes out at 5%. Okay, so that's how it works. Right now, as you probably know, interest rates are very, very low. With a lot that's happened even over the last couple of months, we've had the Fed has come in and they've lowered rates down quite a bit. So we're kind of sitting right here now where interest rates are low. Bonds that people have bought in the past have gone up in value because now bond interest rates have dropped. Well, what happens now when bond rates or when interest rates kind of return back to more normal levels. Again, if this is rates and these are prices over here, the rates eventually are going to start coming back up where they belong, and those bond prices are going to drop. Okay, so bonds can be risky. They can move in price, not to the extent from usually the stocks move, but they still can move in value. That's a bond. All right. Next is real estate. Here is a house that maybe all of you aspire to own someday. It looks more like a hotel than a house. Real estate can be a very good investment. I put on top here location, location, location. So typically, real estate, the value of real estate is driven on location, where the property is. A piece of property in, on the beach in Hawaii is more valuable than a piece of property out in the middle of the desert in Wickenburg, Arizona, right? So it's all about location. Not to say you can't make money on real estate in Wickenburg. You just need to realize what the prices are worth. So location, location, location. There are different types of real estate investments you can make. You have your primary residence. That's just the house that you will buy and live in. It's not really an investment, but for a lot of people, it definitely turns out to be that way. So that's one. You can go out and purchase a rental home where you go out and buy a second home with the purpose of renting that out, or maybe when you buy your first house, you buy a small little house and you live in it, and then you outgrow that house and you move into a bigger house, and you keep your original house as a rental. So rental houses it's a good way to develop kind of wealth over time and to generate income, because those rental houses will pay rent. Like we talked about that, I think, last week. So that rent is just income that can come to you when you're retired or whatever. So rental houses can be good. You can buy a second house or a vacation home, and that home can be rented through companies, vacation rentals, short-term rentals. So some people own second homes that they don't rent. They just keep them available, and when the family wants to get away, they can go there. Others own second homes, vacation homes that they also rent. So that's another area of investment. And then finally, there's also commercial, and those are like offices and buildings and stuff like that. So not that's the difference versus residential, which is homes that people would live in. So you have your residentials, which are your primary home, your rental home, vacation homes, or you have your commercial properties. Over time, these houses or these properties should increase with inflation. So as things cost more money to buy in the future, your house should kind of appreciate to that level. If you buy in a good area, they can appreciate more than that. And if you buy at the right time, they can appreciate substantially more. So typically, real estate does not offer the returns of like stocks, but if you buy at the right time, they definitely can. In addition, oftentimes people will borrow money to buy a house. We talked about this in the borrowing lesson. It's pretty easy to borrow money to buy a house because the bank has that house to fall back on. If you quit making your payment, the bank can come in and take that house back. So because they have that collateral on the loan, it's fairly easy to get a bank to lend you money on a house. And so a lot of times people borrow money to buy a house. And when you do that, it actually can help your returns be higher because you have less money out of pocket going into this investment, and you still get those returns. And so you can get some better investment returns when you borrow money to buy the house. But again, there's a risk there like we talked about. They also have real estate that can be purchased in what's called a REIT, and that stands for Real Estate Investment Trust. And with a real estate investment trust is basically an investment where they package homes together in like stock. So you can buy it just like you buy a stock, but instead of investing in a company like Disney, you're investing in like a pool of offices or houses or whatever. So that's called a REIT. And it's one way that people can invest in real estate without having to like go out and buy a house or whatever. The next area of investing is private equity. We'll kind of go quick through this because it's not an area that probably a lot of you would invest in, but with private equity, you're taking ownership. So equity stands for ownership, and private meaning they're not publicly traded companies. So going back to when we were talking about stocks, I mentioned that this person, they own the lemonade stand that grows, and then eventually they want to capitalize on that, so they sell it, they issue stock, right? It becomes publicly traded, they sell shares of stock, and they get all that money coming in. So a private equity investor goes out, they find that lemonade stand, and they come in and they invest in that company before it becomes a public company. So now you have the person who started the lemonade stand that's going to partner up with this private equity group. They get the lemonade stand owner gets some money up front in cash because he's selling some of the business to this private equity investor, and then they just own it, operate it, and grow it over time, and then sell it, make money or whatever. Okay, so private equity, you own, you take ownership in the investment, but it's private, not public. Similar to owning a stock, you make money as the company grows, they can pay dividends, but unlike a stock that you can go out and sell any day you want on the stock market, there's really no market to sell these private companies, so there is less liquidity. I know we talked about liquidity in one of our lessons, so less liquidity, is harder to get access to your money investing in private equity. Kind of along the same lines as private equity, venture capital. Some of you may have heard of venture capital. And let's say there's a company that's starting up and it's really, really small, and they need money to kind of get this thing going. They've got a great idea, but they just, the company's just small, and the venture capital company will come in and invest in those types of businesses. So it's usually private equity, but it's kind of a different, smaller kind of business that they'll go in. These investments are very, very high risk with great potential return. There's private equity investors that have invested in Google and Amazon and these companies way before anyone heard of them, and those investors have made a ton of money. Okay. But for every Amazon they've invested in, they also tend to invest in a lot of them that don't make it and go out of business. So it's high risk, but high returns. It's private equity. All right, risk return relationship. We talked about this last week, and I stressed it, and I said this is one of the main takeaways that I want you to have from this lesson is that high risk means high return, low risk, low return. You can't have, a low risk investment that offers really, really high returns. It doesn't exist. And if people are saying it does, it's probably a fraud. So this kind of maps out some of these investments that we've talked about. Okay, so the bottom is the risk axis, and then the return going vertical. So as we come out towards the right with risk, we're moving up higher for returns. And typically the graph or the chart does look kind of like this, where it's a steeper curve initially, and then it kind of flattens out, because there's only so much kind of extra return you can get when you kind of move down the risk scale. So it's not like this linear, it's not a straight line, it's going to be curved, and it's going to kind of flatten out as you get a higher risk. Okay. But on the far left, we have T-bills. Those are just really, really short-term government bonds that get backed by the government, so it's very, very safe. And then you can go like a little bit longer-term government bonds. It takes on a little more risk, higher return. Corporate bonds, so you're still a bond holder, but it's with corporations who could go out of business easier than a corporation or than a government could, right? And then you go into stocks, and you've got U.S. stocks are more conservative than international stocks historically, so they offer a little less return. REITs, which is the real estate we talked about. And now, remember, we talked about small cap stocks, so there are smaller companies. There's more risk in that than like just a big U.S. company. So that's a little bit higher on the curve. EM stocks stands for emerging market stocks. Those are stocks like based in Brazil, Russia, India, China. So we call them emerging countries, and that's a little bit higher than private equity way out there on the top. All right, so that's kind of how this is, and it's kind of a curve there. Now, what you can do if you put together the right portfolio of investments, so you're combining some stocks and some bonds and some private equity, you've got this combined portfolio. What you're trying to do there now is maybe get a little bit higher return for the same amount of risk by just owning a single asset. So maybe you're getting, for the same amount of risk as you would have investing in corporate bonds, or just maybe a little more risk, you're getting more returns because you've added some stocks and some other things in there. Okay, so if you get a properly diversified portfolio, you can actually be above this line, and that's what proper diversification will do. That it'll give you a little bit better return at a certain level of risk. I should have drawn that up. I don't know that you'll see if I move my mouse. I guess you can kind of see it moving maybe a little bit, but yeah, now you want it. You want to diversify portfolio, get a return higher at a certain level of risk. All right, I want to talk now about a mutual fund. I think that was one of the definitions that we asked you to look up last week. With a mutual fund, they're very common. It's very important to understand these. All right, so we're going to have 5 investors in this example. Investor A, B, C, D, and E. Investor A has $3,000, investor B $1,000, C $1,000, D $3,000, and E $2,000. All right, so combined, they have $10,000 to invest, but like investor B only has $1,000. So option 1 for these investors would be to just go open up an investment account and invest your $1,000 in a stock or whatever. But with only $1,000, it's hard to get diversification. We talked about not having all your money in one stock. So how do you do that with $1,000? So with a mutual fund, they can now come in and you take your $1,000 investment as investor B and you put it into this bucket in the middle of the square. Okay, that's a mutual fund. So now all of these investors are putting their money in, and they now have an account that's worth $10,000 instead of investor B just having $1,000. And each one of them owns their share of that bucket. So investor B would own essentially 10% of this pool or this bucket, this mutual fund. So rather than investor B just going out and buying one stock, because of my pool, there's now 10,000. Now maybe he owns some of 4 stocks or 5 stocks. In this example, okay, so he owns now Starbucks and Snapchat, Walmart, Home Depot, Apple, instead of just maybe being able to buy a little bit of Snapchat. So this investor now has diversified their risk through owning this mutual fund. This fund is, this $10,000 comes in and it's put in this bucket, and there's a manager now that can manage it and make decisions as far as what stocks to buy inside of the mutual fund. But these investors, they just sit back and they own a percentage of this fund, and as the stocks grow inside of the funds, they make money. Okay, so here's a breakdown of these investors and how much they each own of the fund. As the stocks increase inside the fund, the fund becomes more valuable, and so their investment becomes more valuable. If the fund doubles in value to $20,000, investor A owns 30% of that. They own $6,000. So their $3,000 investment now has gone up to be worth $6,000. Okay, and if it drops, it's the same thing, but the other direction. Each investor now receives diversification from the pooling of money or combining of the money. Okay, so let's go back. This $10,000 gets put into the fund, and how does it get invested? What in many cases, the fund is managed by a manager that now takes that 10,000 and they'll go out and they'll buy these stocks. And now maybe they think Starbucks is really going to take a hit right now in China. They do a lot of sales in China, and with this virus, Starbucks is going to be in trouble. So they decide they're going to sell Starbucks now, and they're going to buy Verizon because people are going to be at home on their cell phones. So Verizon stock would be a good stock to own. Okay, so this manager is the one who's taking this $10,000 and deciding what to do with it, and in return for making those decisions, they're paid a fee. Okay, so this example is $10,000, but there are funds out there that are worth in the billions of dollars. Okay, so we're talking big money, but the concept is the same. Okay, so in that case, I'm talking about a managed fund where the investor is where the money that's in that pool is being actively managed. So there's kind of two ways to invest in mutual funds. There's a managed fund and there's an index fund. With the managed fund, you pay a fund manager, like I talked about, and that manager is going to speculate on stocks. So they're going to look at the stocks that are out there and decide, do they want Starbucks or do they want Verizon? And they'll make strategic decisions. They actively trade that portfolio. So if they feel like Starbucks is not doing bad, they can sell it, buy Verizon. Because there's people behind there making decisions and studying it and things like that, the fees are a little higher because you got to pay somebody to do that. And their objective really is to outperform just investing in the general market. They try to use their expertise to buy stocks that will do significantly better than just like your average stock. So that's a managed fund, and if you can contrast that to an index fund, with an index fund, let's think back to what I said earlier about the indexes. Remember, the S&P 500 is just the 500 biggest stocks in America. So you can buy an S&P 500 index mutual fund. So just like in the slide before, here where you're pooling all your money, you're pooling that $10,000, but instead of having a manager come in and pick what stocks they want to buy, they're just buying those 500 stocks in the S&P 500. So there's no real strategy behind it. You're just buying the index. There's no manager that's making decisions. They're very passive, so there's not a lot of transactions happening in there. There's not going to be, should we sell Starbucks and buy Verizon? It's Starbucks is in the S&P 500, we own it. Verizon's in there, we own it. If not, we sell it. If Starbucks is removed from the S&P 500, we sell it and we buy whatever comes in. So there's not a lot of activity in there. There's not a lot of speculation. And so because of that, they're more passive and the fees are significantly lower. And you just get market returns, which over time is around 10 to 11% per year. That's what stocks would typically do. Okay, so the manager in a managed fund is trying to beat that 10 or 11% per year. And in many cases, they don't do that. So oftentimes it makes sense just to buy an index fund. It's cheap, you get the return of the market, you don't have to worry about it. We kind of think right now is maybe a better time to be in managed funds because of the recent pullback in the stock market. Some stocks are cheaper than others, and so you have a manager that can take advantage of that. But there's definitely times when we like more index funds where let's not pay money to a manager who's probably not going to outperform the index anyway. So that's kind of how a mutual fund works, and that's how an index fund works compared to a managed fund. All right, so that's kind of our lesson for today. In summary, stocks, you own a business. With bonds, you're lending to a business. Stocks have higher risk, higher potential returns than bonds. Okay, real estate is owning a real asset, a property. There's residential or commercial. and you can own your personal home or you can own rental properties. So there's a lot of different ways to do that. And then private equity. Private equity is where you can invest and take ownership of private companies. All right, that's kind of the main investment areas we focused on. And then we talked, of course, about risk return and which of these investments are riskier than others. And then to reduce your risk, you can invest in a mutual fund where you pool your money with other people. It's mutual. You mutually fund it. That's why it's called a mutual fund. And then the manager invests it for you, either actively or passively in an index fund. All right, so that is kind of our lesson for today on investing. If there's another investment out there that you would like us to talk about or explain, I'm happy to do that. I can send out a quick video, but I think this kind of covers the main areas of investing. The homework assignment, again, pick three different companies, okay? Give me the names of the companies. I want you to tell me the symbol, stock symbol, name of the company, current price, 52-week high, 52-week low, and email those over to me. And then start tracking these. So I want you to go in every couple of days or so, or every day if you want, and see how the prices are changing. And tell me in a week or two. I want you to report back and tell me if you're making money on your stocks or losing money on them. Okay, so that'll be your assignment. We appreciate you watching this lesson today. We hope it was informative. And as always, call us or email us with any questions or any help that you might need, or if you have any other investments that you've heard of that you want us to explain, we're happy to do that. All right. Thank you so much. Have an awesome day.